In times of economic slowdown, there are few good places to hide in the stock market. Those areas that are well insulated from any pullback. Well, one area we're talking about now is infrastructure spending. This is quite often used by governments in fiscal stimulus, where they look to spend public money on big projects, schools, hospitals, rail services, and so forth. I'm talking now to Randall Sandstrom, as Chief Executive and Chief Investment Officer of Sequoia Investment Management Company, which is an investment advisor to the Sequoia Economic Infrastructure Fund, or ticker SEQI, which is available on the IG investment platform. It's a FTSE 250 specialist in economic infrastructure debt, and it's the UK's largest debt fund. Randy, welcome. It's a pleasure to be able to catch up with you. Let me just ask, first of all, as a big picture question on why infrastructure? What is it about infrastructure we as investors need to know?
Well, I think, Jeremy, and thank you very much for having me on the show. I think one of the good things about infrastructure is that it's something that everybody knows. Infrastructure touches everybody's life almost on a daily basis, be it from riding on a bus or on a train or having to go to the hospital or going to school. So it's a sector that people know. It's a very large market, and as an investment manager, that helps us build a really diverse portfolio. It's large in the sense that it's absolutely a big market, but there's also a lot of issuance. For example, in the US, it's estimated that there's about $400 billion of issuance per annum in the US, which gives managers like us lots of opportunities. Same thing in Europe, not quite as big, but still over $100 billion a year of issuance. So it's a nice big place to invest. The other thing that's good about it is that infrastructure is a hard asset. The instruments that we invest in are not backed up by some arbitrage in the market or some interest rate differential. There's an actual hard asset. And that's important. In case the investment goes bad, we can actually foreclose on that investment and sell it if we have to. And to have a hard asset helps that process.
Now, I said in the introduction, you are a specialist in infrastructure debt. Is that much different from what you've just been talking about? Is your approach different to infrastructure because you're a debt specialist?
It absolutely is. And that's quite an important distinction. There are basically two ways for investors to get involved in infrastructure. You can either go into the equity, which is at the bottom of the capital structure, and I'll explain what I mean by that, or you can go into debt, which is at the top of the capital structure. And the way to think about it is just think about the balance sheet of any company or any project, or really just think about your house. When you buy a house, you come up with your down payment. That's your investment. That's considered the equity portion of the financing of your house. The bank then comes in behind you and or in front of you rather, and they make to the home. So that's what we do. We are involved in lending to infrastructure projects. And, that money can be used for a variety of things. Oftentimes it's used to refinance an existing loan. Perhaps that was used to build the infrastructure project. We don't really get into too much construction financing. Or it could be a loan which is used to expand the business. But what we don't do is get involved in owning the infrastructure project and investing in the equity. Now, that's a fine place to be if people want to take those sorts of risks. But the risk in equity is that even though you stand to make the most money and the most return if things work out well, if the asset that you've invested in doesn't work out well, because you're at the bottom of that capital structure, you're in effect a deposit on your house, you'll be the first one to lose money. So we're much safer in that capital structure by being in debt.
Okay, so you've explained that point about equity being at the bottom. Just to explain more about how you approach this as a fund manager now, because the fund that's been set up, as I said, you're FTSE 250 listed, you're a specialist in debt. Explain more about the fund that investors can pick up on.
Absolutely. Thank you for that. Well, we're a listed fund. So as Jeremy said, we are listed on the London Stock Exchange. We are part of the FTSE 250, and the fund simply issues shares. So you can call up your stockbroker and buy the shares on the secondary market. You don't have to wait for a new issuance of shares. The shares trade quite actively on the LSE. And what we do with that money when we issue shares is that we then make loans to infrastructure projects. The return on our portfolio right now is about 9%, which is relatively high. And we get that through, and this is really important from a risk perspective, through a diverse portfolio of infrastructure loans. And right now, the size of our fund is about £2 billion in size, and that's invested across 72 different loans, 12 different investment grade jurisdictions, which is important. And this gets back to my first point that I made about the infrastructure being such a large market. It gives a manager like us lots of opportunities to find different optimal risk return assets.
When you say you're returning, what do you say, 9%, did you say, per annum?
Well, the yield on our portfolio right now, about 9%. That's correct.
Yeah, so that was what I was going to ask you to clarify. So you're talking there about dividend payments compared to what, the investment share price chart, share price?
Yeah, exactly. Well, the yield to maturity on the portfolio is a slightly different. There are lots of different measures of yield, but I'll talk about two important ones. There's the yield to maturity on our portfolio, which that's the 9% number, circa 9%. And out of that, we've got to pay the costs of the fund. And then also, after the costs are paid, we then pay a dividend out to shareholders. Right now, the dividend yield, what's called the current dividend yield, would be just over about 7.4% on our share.
Okay, so let's take a look at the share price if we can, because we've seen this recent dip, and in fact on this chart here you can clearly see it's not too far away from the COVID lows we had around about 77, 78p. We have seen a little bit of a rebound recently. To what degree, Randy, is this a fund issue, or is it a general sort of market issue, this drop that we've seen? What goes into this drop that's been seen?
Yeah, absolutely. It's largely the latter. It's a market issue, and the reason I say that is that we're in a cycle right now of increasing interest rates, and in general, you see fixed income type investments sell off when interest rates go up. However, and this is a very important point to make, it depends if you're looking at short-term interest rates going up or long-term interest rates going up, because they mean different things. By short-term rates, I'm talking about, for example, LIBOR going up because of the Federal Reserve or the Bank of England raising short-term rates. The effect there is actually quite positive for our fund. And the reason I say that is a large portion of our portfolio, just over 50%, is what's called floating rate loans. And what that means is as those short-term rates go up, the interest rate that we charge resets and goes up. And so more income comes into the portfolio. The reason that's important is because that increases the strength of our dividend cash cover, the security of the dividend, which right now is in excess of 1 times. The second point about longer term rates going up, and that dip in the share price is really more of a function of longer term rates going up. It's really a short-term phenomenon. If you have fixed rate exposure, not floating rate like I talked about, but fixed rate, and interest rates go up in the market, the price is going to react by going down. The important point is that this is temporary. This is just a mark-to-market. It's not a realized loss. And once rates settle back down, what you'll see is what's called a pull-to-par effect, where those fixed-rate loans will go back to par value, which is 100 cents on the dollar. So this really, in my opinion, provides quite a buying opportunity for investors to get in at a cyclical low on the price and ride that price back up as rates settle down.
Okay, yep, I get that. But I just want to confirm, the fund benefits, or rather responds positively to rising rates, but at the same time, it's also a hedge against inflation. Is that correct?
We aren't explicitly hedged against inflation. However, there is an implicit hedge, which infrastructure in general enjoys. And what that is that if you think of the basic investment strategy during a high inflationary environment, it's hard assets. So the most typical hard asset would be property. Property tends to go up when inflation goes up. Infrastructure is the same way. Infrastructure represents an actual project, an actual real asset. So you'll see asset values go up. The other important point about inflation and infrastructure is that there's a built-in hedge, because projects can charge more to their end users, to their customers, when their prices go up. And it's actually easier for an infrastructure project to pass on price increases from inflation than a normal corporate. And the reason for that is that the cost of using infrastructure is pretty low. It's a very small part of one's disposable income, be it a toll for a toll road, or your electricity bill, or perhaps your mobile phone bill. So what that means is that projects can increase those prices without dramatically causing a drop in the demand for their service. Whereas if you look at a corporate, like an industrial, consumer companies such as selling cars or big ticket items, those companies aren't nearly as able to pass on inflationary price increases as infrastructure projects.
You talk as well about this diversification. Sort of pick up on that point if I can. Are you talking about jurisdictions, sectors, or what is the diversification you're offering?
Well, there are four different types. One is the actual projects. So those are what we call, the single names. Those are the borrowers. We have 72 different borrowers in our portfolio. And then you can look at more of a portfolio diversification, where you look at different sectors. We have over 10 different sectors. These are different industries, they're also called. And then also within each sector, you have different subsectors. And then fourthly, it would be the geography. We've got 12 different investment grade jurisdictions in the portfolio. And this is really important because diversity tends to bring down the amount of variability of the income to the portfolio. And that has really served us well since we started the fund over 7 years ago.
Also, I notice in the notes, the fact sheet that accompanies the release, you talk about thematic investing. How does this dovetail with diversification?
Well, what we want to do is we want to go into investments that offer, a good risk return profile. And one of the themes that we've been looking at before COVID, but particularly during COVID, was the TMT sector. So this would be telecoms, for example, media and technology. And, this is a defensive sector. Within the telecoms component of TMT, we're talking about data centers, undersea data cables, mobile phone cell towers, fiber to the home. These are services that people pretty much want, even during a downturn in the economy, which makes it a defensive investment. And that's been an important theme for SECI throughout COVID and still to this.
How do you engage with ESG? This is a relatively new phenomenon. I mean, I've been in the markets for the best part of 40 years, and this is certainly new to me. It's obviously a big thing now, and we have to accept it for what it is. And of course, it does take us on in terms of how we approach investments. How do you engage with it?
Yeah, that's a really good question. And you're absolutely right, Jeremy. ESG is becoming a very big theme in the market. And there are really three components to our ESG work. The first is measuring it. So what we want to do is we want to measure each of the investments, each of the loans that we make in terms of how does it score in terms of our ESG model. And our model is part of an entire ESG philosophy that we've written and a policy that we've written for SECI, the fund that we manage. So the first thing that we do is we measure the ESG. The second thing is interaction with the investments that we make. And what I mean by that is when we make a loan, we send out a relatively large questionnaire to all of our borrowers. And we want them to fill this out. And we want to know, what are they doing in the ESG space? And can they actually show us what they're doing? And then thirdly, what we do is we report our ESG exposure to our investors. And, our goal is over time to get a higher ESG score in our portfolio.
Well, I was going to pick up on that point about how you go through the filter process. Presumably you have a negative screening process, if you like. You exclude those that you don't want to touch because they don't comply?
That's right. The very first step would be what's called negative screening, and that would be just ruling out, assets that we know we just don't want because they just pollute too much. A perfect example would be a coal-fired power generation plants or oil and gas exploration. These are companies that we want to stay away from because they just score so badly on ESG.
Yeah. Let me just round off, if we can, with taking a look at the fund and how things are going in terms of performance. We've seen a look at the share price chart. You talk about your investment returns and so forth. It's what, £1.5 billion, I think, is the market cap at the moment for the fund, the SEQI fund, SEQI fund on the FTSE 250. Just give us a bit more of an insight into how the performance is going and how you see things developing, bearing in mind this high inflation, high interest rates, volatile market situation, but the opportunities that clearly present themselves to you as a fund manager.
Yeah, well, it's going well. Infrastructure is a defensive market to begin with. And within the infrastructure space, we've really gravitated toward the more defensive part of the infrastructure market. We've got about just over 50% of our assets in the most defensive, the most secure parts of infrastructure. It's going well. The IRR, or the return on our net asset value, since the inception of the fund, since just 6 months after the inception of the fund, that 6-month period is when we were ramping things up to begin with. So that goes way back 7 years ago. That number is 6.6% per year. We're happy with that. Our dividend is 6.25p per share. That dividend is covered well by cash. And the dividend has gone up. We started at 5p per share. We then went to 6p per share, and we're now at 6.25p per share. And importantly, and this is very important, we think we're well positioned if we do see a downturn in the economy, if economies go into a contraction, into a recession because of the central banks raising rates so much. We're well positioned because, first of all, infrastructure itself is defensive. And secondly, we've got a large part of the portfolio in the most safe parts of the infrastructure markets. And then lastly, the important point to make is, we talked about earlier, with interest rates going up, short-term rates going up is actually positive for our portfolio because that'll increase our dividend cash cover and the security and the strength of the dividend. And then there's that sort of built-in, that implied inflation protection, where infrastructure projects can pass on these price increases to their customers.
Look, we'll have to leave it there, but thanks for joining us. Insight into the fund that you manage. Randy, it's good to talk to you. Thanks for your time. Randall Sandstrom is the Chief Executive and Chief Investment Officer of Sequoia Investment Management Company, the investment advisor to the fund, the Sequoia Economic Infrastructure Income Fund, a FTSE 250 listed fund. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.